Yay. Yay.
Hey, hey, hey! It's another water cooler
Hey.
Wednesday. We're
How
back
y'all doing?
again. Right. Hey, so we're back again. Another water cooler Wednesday. My name is Dion Branch, and I work with Real People Realty. And I have with my co-host. Go ahead.
It's me, Lisa Delinda, House Money Mama in the hizzy.
Right. And then today we have a special guest. His name is Eric Johnson, right? And he's with Goosehead. So welcome, Eric Johnson.
Thank you.
Right. We're so glad for you to be with us today so you can share all the information we need to know about home insurance. So I know you all probably cover more than just that, but um while we're talking about buying homes and things like that, what happens is my clients, they're in that buying the house, and the lender asks them what about insurance, who's going to be their insurer, and I'm trying to figure out, like, why I need, everybody go, why I need insurance. What I
Mhm.
for. So I don't know. Lisa, maybe do you have an idea as far as what the insurance, why you need insurance as far as the lender standpoint?
Well, I mean, from a lender's perspective, obviously we want to have the insurance on the home. So because we have a vested interest in the property, we put a lien against the property. So if anything were to happen, then the lender is at risk for having to recoup, from any of the losses that may occur from whatever happens with the home. So we have a vested interest. So yes, for us, it's a requirement. You're not gonna close that loan if you ain't got insurance. So, and if you decide that you're gonna let your insurance lapse and you're not gonna pay it, we're gonna put one on there for you. And you're probably gonna end up paying about 5 times as much with our insurance than what you will if you go with somebody like Eric. So
Right,
yeah.
right.
Now, what it covers, what all the things are as far as details of what it covers and things like that, and I really can't speak to that. That'll probably be Eric.
Right.
Probably, huh?
No, give me a hard time today, Eric.
Right. So Eric, what we need insurance for?
Okay. So, well, the two primary reasons in the home purchasing situation is one of them that Lisa actually spoke to. It's a contingency. It's mandatory prior to closing. You have to be insured, and the reason is, like Lisa said, the vested interest. And they do that via what they call a mortgagee clause. So there's a clause, a legal wording that's put onto the policy that mandates that if something happens to that building, i.e., a loss, a fire loss, or something, that they're going to be covered and recouped. And so it's protection. Once again, their interest, their financial interest, and it's likely the same thing with the home buyer. You're protecting your financial interest. So, for example, you're in a $400,000 house. You have a fire, a total loss, meaning everything's wiped out. What's the likelihood the average individual does not have enough means to actually recover from it? Meaning that, can you come out of your pocket 400,000 and replace that home? And then even if
Yeah.
you could do so, you're still going to be in trouble. Meaning there's still going to be a monthly payment from the mortgage company that you would have to take care of. So it's actually to
Yep.
protect you both on the financial side of the borrower or the home buyer, and then also via the mortgagee clause, protecting the financial institution against loss. So those are the primary reasons why you need it, and then there's other coverages that we'll get into, and other things. It's basically protection on both sides. So just to recap, you it's mandatory. It's a contingency on the lender side, and you want to personally protect your assets to be able to recover from any loss that you can't, any substantial loss that you can't recover from on your own.
So
No,
I got a
okay.
question. I know we talk. I'm always on the part about the lender because that's what I do. But like, let's just say if somebody purchased a house and they bought it cash. There's not a mortgage on it. So there's really not a requirement from a lender to have the insurance. What would you say to a person like that in regards to have insurance or to not have insurance? Like what would be the benefit for somebody like that?
Well, then in that circumstance, when prior question, similar question, you would lose one of the benefits, and it would just be your personal situation where, for an example, if there was a fire, even though you paid it in cash, I think you would want to pay less to recoup that total loss than coming out your pocket. So you bought a property for $200,000 in cash. I think that you would want to pay less, i.e. a smaller amount to cover that complete loss, right? So an insurance premium, a monthly premium is always going to be a cheaper way in a monthly or even a yearly cost to recoup your costs. You also have liability we'll talk about coverages that's built into your policy. So for example, Lisa comes over, Dion comes over, and we're having a housewarming. Lisa did the loan. Dion sold me the house. So we're all excited. Lisa has too much to drink.
She's like, what?
Lisa slips in the family room doing the cha-cha slide and tears her ACL and has to have surgery.
Right.
Then all of a sudden we don't become friendly anymore, and she wants to sue me because she has 90,000, 100,000 plus in injuries. So she wants somebody to, hey,
I can't just kick her out.
No, we tried that doesn't work. So she brings her fancy lawyer back and sues her. So that's another reason. There's liability that's built into these policies. Or you have your precious Chihuahua that you think won't bite anyone, and I'm walking and jogging across, your front, and the Chihuahua comes out and attacks me and bites me. So that's also a coverage that's afforded to you as a result of that.
Okay. All right. So
there was a story that you told on a previous live that we did.
She going right for the jugular.
Especially you put me out there. I came to somebody's house drinking, so you already know what's coming next.
Right.
So anyway, there was a story that you told on a previous workshop that we did together where I thought it was really good. So I'm poking fun at you, but I thought it was a really good story because it helped me to have a visual of what makes sense as far as how things are, how it's decided upon what's covered or how you can think of what's covered with your policy. Can you tell that story again? The one about the house?
Okay. So we have our home that we live in. There's a variety of coverages that are built into your policy. It would take too much time, and I don't think it would be of incredible benefit to anyone if I illuminated like every single coverage. But for the most part, you can really break this down into two major parts. The two major parts are property coverage, and then there's liability coverage. Okay, when you're talking about the property coverage, so you have the physical property, which is your real property, i.e. your home that you own, the physical structure. You have your garage, be it attached or detached, that's covered. So that physical structure is going to be covered to a certain amount. And that also takes me to a point where, you have a contract amount, which is what we call market value, what you're going to purchase that house for. And then insurance, we have this thing called replacement cost. So you might have a house that you purchased for $250,000. The lender is going to say, hey, you have to insure this house up to $250,000 because of the reasons we talked about before, because they want to make sure that if something goes wrong, their money's taken care of. But that amount of $250K may not cover your interest completely. And what that is replacement cost. So that house very well could cost more than $250,000 to replace. So it might be $300,000. It might be even more than that. And so we're going to cover that for not market value, but replacement cost. 100% replacement cost. All right. So your physical structures are covered. What else does it cover from a tangible property standpoint? Your stuff. And what I mean by your stuff is if I was to take your home, like Lisa said, turn it upside down. Right. And I was strong enough to shake it out. All those personal items, your stuff that will fall out, those your personal effects, those are also covered under property coverage. in your homeowner's policy. It's covered as a percentage of your dwelling amount or percentage of your house amount or your coverage A. So those are two major coverages that are afforded you in every standard homeowner's policy. In addition to that, the stuff that we joked about, the liability, slip, trip, and fall, those types of things, those are the two major coverages that are built into your policy. There are some other coverages. For an example, if you were to suffer a fire loss and you had to be displaced, so that's going to cause some type of financial harm to you, right? So who pays for that, right? The insurance policy also would pay for your stay outside of your house up until a certain period of time and a certain amount, and that varies from contract to contract or policy to policy. So what we were talking about is the two major coverages are your property and your liability coverage. Property being real property and personal effects. The real property is your actual physical structure. Your personal effects are all the things you put into your home, that you bring into your home after you close, i.e., as Lisa said, the things that if you picked your home up and shook it, anything that would fall out. And then there's some other caveats where Lisa has this beautiful $20,000 ring. That $20,000 ring is not covered because of that amount on most policies. So there's a special policy, endorsement, or rider that you need to have to cover that. Lisa also has this beautiful mink fur, a chinchilla fur, full length, very expensive. So that
I can't wait to meet this new Lisa. I can't wait.
So she has to be covered from that, and to protect all of that, she has all these Rugers and Berettas and AR-15s, right? So those guns need to be protected in a certain way too. So each homeowner's policy covers those certain things up to certain limits. But if you go above those limits, which most people do, in particular with Lisa's nice $20,000 ring, it needs to be covered some other place, and meaning covered some other way, i.e. a floater or via endorsement. And that endorsement also a lot of times gives broader coverage. So Lisa was on the beach, relaxing, drinking a Mai Tai, had a little bit too much again, and she left her ring. She left her $20,000 ring that a man bought her in the sand. Wow. And then she gets back from Hawaii. No, you was in Tahiti, not Hawaii. You was in Tahiti. She got back, and the ring mysteriously disappeared. There's coverage for that in a lot of these riders. So if you cover it properly. So, we're poking a little fun, but just to make it a little bit interesting and simple, that policy is really covered. The major two coverages are the property and the liability coverage.
Right.
In those
so I think you kind of covered this, but I just want to talk about Pookie and them, right? They always happen, right? And they like, now, this happened, and now I'm gonna get me a whole new TV, right? Right, or I'm gonna claim like that ring that I never claimed, that we don't know anything about. Basically, a lot of times here, do you need receipts? Or what do you hold on to? Say I do have those riders and things like that. What do I hold on to so that I can make sure that I'm able to claim what I need?
Well, each company varies a little bit on the requirements, but in general, I'm making a very broad statement. Your coverage B, or your personal property coverage, is actually gonna be a percentage of your coverage A. So you're gonna get a nice amount that's afforded to you for like your bedroom furniture, your couches. You're not gonna have to really present a receipt from that. But when you start talking about diamond rings and such, like the $20,000 ring, we're gonna need an appraisal. If you start talking about substantial items like firearms that's custom made, or a chinchilla fur that she has put away, we're gonna need some receipts for that. And so there are documentations that's needed for those high ticket items, but your normal stuff, your bedroom set, your furniture, that's not gonna be really disputed. And once again, without getting too deep, insurance really has a lot of moving pieces, and there's a lot of different professionals. I used to be an underwriter at one point, so those people are just like the underwriters in the on the loan side, where they actually seeing if are you worthy of the loan, are you worthy to take a risk on? So you have those people, you have salespeople like myself, and then you have the claims people, right? So each person comes out and determines a person comes out and determine if this is a coverable thing, and they're interpreting the contract. And so it's really going to depend from company to company what they require. Some people don't require that type of documentation, but there are other people that do. So I would say definitely when you have a substantial amount of property or special items like a ring, you want to make sure that that you keep your receipts and you have your appraisal. That's the number one thing. Most companies are not going to allow you to insure a ring of over a certain amount if you don't have an appraisal. High ticket items, I definitely would have documentation for. But your agent will also, if you're asking that to be insured, will also tell you of any requirement requiring documentation or trailing documents that they need. But a lot of people don't understand or don't know what to ask. But that's why we have these types of information and making sure that you're going to a professional, not somebody who just has a license, because those are two different things.
Right. Okay.
Good point. Very good point.
So, Eric, I wanted to kind of talk about Goosehead, right? So a lot of people, everybody's like, "Oh, State Farm," and Allstate, and so then they're like, "Well, I never heard of Goosehead. So what's Goosehead? What's your company about, and how are you different than the name brands?"
Well, Goosehead is actually the head of a goose. That's what the Goosehead is.
Really, Eric.
So in my case, Goosehead it can be kind of misleading, right? So you'll see Goosehead Insurance, and one of the things that we've had to talk about is a little bit of education, where you're presenting it to the client. I'll often say, I'm an independent broker. I work for Goosehead. That's the name of my office. It's not an insurance company. So that'll lead me into the discussion on the ways that customers can purchase insurance and who they can purchase them from. So here you have insurance companies, right? And there's tons of insurance companies, not just the main 5 companies that you might see on your television that spend quite a bit of money advertising. That historically, I would say 20 plus years ago, insurance companies didn't advertise like that. They used their agents to advertise. Geico came in and disturbed that model and started spending a ton of money. And then, the State Farms got off the porch and started spending a lot of money. Allstate, American Family, Farmers, and they're all great companies. And it's not my opinion. Each insurance company is AM Best rated or should have a rating. So you really want to stick with a company that's AM Best rated, that has an A+ rating or A rating or above. That's something that's verifiable over Google. You can Google it. So State Farm, American Family, Travelers, Progressive, Nationwide, those are all excellent companies, and they're rated, not my opinion, but rated by AM Best from ability to pay claims and financial paying ability. So the difference between me and, say, the company that I worked for 18 years, State Farm, and when I was in State Farm Corporate, State Farm agents are great agents on average. State Farm is a great insurance company. But their agents can only sell State Farm insurance, right? An Allstate agent can only sell Allstate insurance. I'm an independent, which means I have 40 companies that I can insure you with, right? And what's in that for the average client is that one size doesn't fit all, right? None of us go to a shoe store and say, hey, I'm gonna go to the shoe store that only fits 6s. No, I wear 15. All of us, we need variety. But not only to the variety piece, behind closed doors, what the customer doesn't see is that each individual insurance company has a different underwriting appetite, meaning they like certain risks and certain things they don't. So your say, for example, your roof might be X amount of years old. Certain companies don't like that. Or you might have a pit bull. Some people don't like that. So different situations, you have different underwriting appetite. But the biggest thing is that there's different rate cycles. So rates go up and rates go down, right? And each insurance company is on a different rate cycle. So you might have saved, it might be a better fit for you to be with State Farm today, but 2 years from now, it might be a better state for you to be with Nationwide. So the difference between me and a State Farm agent is that they can only put you in this one box that they have. Technically there's more little rating tiers that they have built in, but I have 40 different companies. For example, if that company came back to you, which all of them do, and raised your rates 2 years from now, and you went to your captive agent. So a captive agent means like State Farm, Country Insurance, great companies, great agents, but there's not very much they can do without starting to strip your coverage, right? So they can raise your deductibles, starting to take things away from you to lower your price. You come to me and say, hey, Nationwide raised my insurance by, X amount of dollars. I can say, you know what, Lisa, I work for you. I don't really work for this company. Let me go back on the market and shop the other 40 companies and see if we can find something better for you. That might be the best price on the market. It might not. So I just have the power of choice behind me. And one thing that we recently have been seeing is Nationwide used to distribute or sell their insurance via captive agents. Because of this power of choice, the stuff that's happening in the world like Amazon and things, more insurance is being sold and pushed to the independent channel. So I have Allstate now.
Really?
Okay.
I can sell an Allstate policy as of the 1st of this month.
Oh, wow.
Right? So,
Wow, congratulations.
Yeah, I mean, and the truth of the matter is Allstate's a fabulous company. Only thing it does is more brand recognition because they advertise a lot. But the truth of the matter is, when I run quotes, Allstate doesn't come up in the top 5 from a pricing standpoint most of the time.
Right.
People will go to a place and overpay simply because it has a name that's familiar. That's the power of branding. That's the power of advertising. And these policies are really what they call, are based upon a lot of, I don't want to get too technical, but ISO language, right? All these policies are contractual. They're based upon court law, right? So they're all legal, all written in legalese by attorneys. And so they're written in such a way that if they went to court, they'll stand up. So insurance companies take and pick, they don't make their own language in general. They pick from this company called ISO. So all the policies are pretty much worded the same. The coverages are the same. The way that they derive those coverages are pretty similar. And therefore, the product has been commoditized. Now, that sucks for a State Farm agent, or it sucks for another captive agent, because they want to make you think that, hey, it's something special. No, it's nothing special about P&C for the most part. But, it's really price driven a lot of times because it has been commoditized. They don't want you to know that because they don't have any choice. I'll tell you that all day. For one, it's the truth. And for two, I got choice. I got 40 companies that I can place you with. So I'm an independent carrier that works for you, not necessarily the insurance company. Even though I have some responsibilities to do, but I function not legally as a fiduciary, but I function as a fiduciary doing the best for you. If they come to me and they're in a better situation with a State Farm or a country company, I'll tell them to stay there and see me in another 2 years. But that's pretty much it. The difference.
That's a question I have for you, right? So a lot of times we buy insurance and we stay there for 20 years, right? You never look for any other insurance. How often really should we shop for other insurance?
It's my opinion that you should shop every 2 to 3 years. Once again, if when I worked for State Farm, you would cringe if somebody, that's not something that an agent's going to tell you. And the reason why
they want you to stay.
They want you to stay. They want you to stay.
They want you to stay.
And I don't blame them. It's nothing, that's evil about it or anything. But the truth of the matter is rates change and your personal situations change. So, for example, I had to say a given insurance company had a terrible experience. And what I mean by experience is that they suffered a bunch of losses over the last 5 years. For them to still be solvent and profitable, they have to raise their rates. So they're going to take a rate increase. And that rate increase is going to affect, it's not just they're going to target and say Lisa was at the party or, Dion was at the party. No, they're going to target the whole class, right? It's the spread of risk, right? So they're going to, you're going to have these average rate increases. Some of them are affected. Some people are affected more than others. Sometimes it's rate neutral, meaning it's nothing. But most of the time, when your rate goes up, right, you're not going to know about it. You'll see it in your wallet, but you're not going to know that hey, right down the street, this other company that's just as good, just as great service, they took a rate decrease because the last 5 years that they've been profitable and haven't had a ton of losses. So they're going to take a rate decrease, or they didn't have they had a bad cat year. It was a cat year, is a catastrophe year, where there's hurricanes and different storms, and that eats into the profitability of the insurance company behind closed doors. So insurance rates are always going up and down, rising and falling, and it's really up to you probably every 2 years to shop. A lot of reason why people don't want to do it, they want to set it and forget it. One, with the homeowners policy, most people are escrow, right? So they don't really see it. The mortgage company takes care of it. They don't want to spend the time to go and shop all these different companies. That's another benefit of working with an independent agent, not just Goosehead, but an independent agent in general, is that they'll have the ability to say, hey, Lisa, I'm going to do all this work for you. I'm going to shop 40 companies back, come back with your best 2-3 offers. And say, hey, this is what it is. So I say 2 to 3 years if you ask me. And I think you should review your policy probably on a yearly basis. For example, Lisa bought a new house. You know, she had an unfinished basement. 2 years later, she decided to finish that basement. Right? So she got it all decked out, got her woman layer down there.
A woman layer.
A woman layer. I didn't come up with the term. I didn't want to say man cave, but you know, the woman.
It's her she shed. What's her she shed?
The sheep, that's State Farm commercials. I ain't gonna say the sheep. A she cave or something down there. Right. So she got this basement finished, right? Well, in your original policy, you didn't add water back up. In that original policy, you know, there was no coverage down there for that basement. So you need to let somebody know and make sure it's properly covered, because in April, your sump pump went out. Well, if you didn't add back up in water, sewer, and drain, there's no coverage for it. Right? So you need to have those types of things taken care of and have those conversations with your agent.
Well, that's interesting to know. Okay.
Very, very informative. Very informative. And I like the story too.
You like that $20,000 ring and
like the furs, my Mai Tai on the beach. Yeah.
Right. We want to make sure that
this Lisa. I can't wait to be here.
Right. We want to make sure we covered all the way, because I want to make sure everything, my furs, my meat, you know, like all that, right, it's covered under my insurance. Right. So, but yeah. So Eric, thank you, for joining us.
Absolutely.
And you can, if anybody's interested in getting an insurance quote, you can contact Eric Johnson. And you don't have to buy a house to go get an insurance quote. He told you 2 years, you should go and just kind of shop. Let him shop for you. Let him determine if you're paying too much for your insurance. So this is probably a good time to reach out to him and just give him a call. So right. Now you wanna get pre-approved, because before you work with me, you gotta come to Lisa first, right? So
I'm your girl,
right? And Lisa has some announcements. She she's at a new place now.
I am,
with a lot of great programs.
Yep, Geneva Financial. Yep. And so especially for the first time buyers, we're able to do down payment assistance now. It's a definitive program that's actually government backed, from what I understand. So we do 3.5% up to 5% of your purchase price to help you with your down payment and closing costs. So I'm very excited about that. Yes. Yay.
All right. Congratulations. And then and then again, my name is Dion Branch, and I work with Realty, and I have a great team of people that I work with, and I like to bring them to you every week so they can share with you the information that you need about purchasing a house and insuring a home and everything that goes along with it. So we look forward to seeing you next week.
Next Wednesday.
Right. Thank